Hello from the campus of the Ohio State University Fisher College of Business. Welcome to the National Center for the Middle Market Mid-Year Middle Market Indicator Update. My name is Doug Farren. I'm the managing director here at the center, and we are pleased to continue to bring the latest and greatest insights from the U.S. middle market to a number of different audiences. So again, I'll be spending the next about 45 minutes or so kind of going through the latest data and insights from our semi-annual middle market indicator. I would encourage you, if you have questions, to submit them online. We won't be taking live questions, but you can put them in either the chat or I think specifically the Q&A function is probably the best place to do that. So let me continue. So what we're going to do today, I'll tell you a little bit about the NCMM, the middle market, how we define it, how we conduct the MMI report. We'll go through the latest data as well as some of the projections for the upcoming 12 months, and then spend a little bit of time focusing on some of the biggest issues and challenges that the middle market is telling us, mainly around uncertainty and how that's causing them to create and take a more defensive posture as it comes to managing their companies, and then we'll wrap up after that. The first thing I want to do, though, is welcome a new partner to the work that we do here at the NCMM, which is Wells Fargo. So we've worked with Wells Fargo previously. We met their team several years ago. That culminated in a project that we did together studying Black-owned middle market businesses. We released that report in the spring of 2024. And most recently, the Wells Fargo team has come on as a project sponsor for the NCMM, which will include our semi-annual middle market indicators. So we greatly appreciate the support. We're having meetings and getting that relationship up to speed, and everything is going really well so far. So again, shout out to Wells Fargo and that team. We're happy to have them with us on this focus of the middle market. Also wanted to share that, and this is kind of a broader message outside of the MMI, but the middle market is gaining notoriety. Again, when the center was launched 14 years ago, one of the things we were trying to do was elevate the profile and the recognition that middle market companies are essential to the U.S. economy. That is becoming more evident in my time here at the center, which again, I helped launch the center in 2011. I have not seen this level of interest and attention, particularly as we think about national media outlets. So just some examples of those here from the past 4 or 5 months include a story that I was interviewed for by the Wall Street Journal. Again, when the trade policy was being developed and the initial round of tariffs were announced, there was certainly interest in what this meant for the middle market. Fortunately, we have some data that I'm going to share today that talks about that. More recently, Time.com did a profile of America's top middle market companies. Definition was slightly different than what we use, but I was happy to provide some commentary and insights around the middle market in general. And then we also did an interview with writer Josh Mann for the business journals, which are regional publications that go out in a lot of the major markets around the country, which was, again, more of a tariffs focus, specifically around manufacturing and supply chain and what that would all mean. So I say that with the backdrop here that if you're attending this and have been following the work of the center or new to the center, it supports the idea that the work that we're doing here is very important. And as we'll see, there are some specific challenges and issues facing middle market companies now, which we're going to continue to monitor, and hopefully they get addressed to not negatively impact growth as we've been tracking over time. Oops. So NCMM, again, I assume most of the attendees on this webinar are familiar with us. If you're not, we are a research center, the only one of our kind in the United States. We are located and based at Fisher College of Business within the Ohio State University. And we were launched in 2011, as I mentioned, to really do one thing, and that's support US middle market companies. We do that in a couple of different ways. Three buckets of activity: research, such as the MMI, which we'll focus on today. We also do all types of topical studies on different topics related to middle market business. Outreach and engagement. So we've developed over the years a broad network of partnerships which allow us to reach various middle market audiences from literally from coast to coast. So we travel, we're on webinars, podcasts, other channels to really share this information. Again, with that objective of elevating the visibility of the middle market, also talking with specific audiences about topics of interest, challenges, opportunities, things of that nature. And then third is education. So that could be from a student point of view, also from an executive point of view. We have a program that is now starting to build momentum here in Ohio. It's a partnership with the Ohio Chamber of Commerce called CEO Forum, where NCMM content is helping to drive some of the educational component of a middle market leadership program designed to help companies scale and grow. We are, again, a partnership with Chubb, Visa, and as I mentioned, most recently, Wells Fargo. And we're very much appreciative of the support, not only from the funding and the gifts that they provide into the center, but also the subject matter expertise and the points of view that they can provide to help direct and guide the research and activities that we do. US middle market, again, we use a revenue-based definition, 10 million to $1 billion. We've maintained that since we started. Again, the numbers are going to change over time, but at the time we launched, that definition captured 200,000 businesses and almost the perfect slice of the middle third of the US economy from both the private sector GDP as well as employment standpoint. This is refreshed from the standpoint of the ownership. It's actually over 90% privately held, which again makes information about the middle market difficult to obtain. And so, we see part of the value of the center is actually shedding light on mid-sized companies, but also providing data and information that others can use as well as they continue to work with and support these companies. I have to double check this, but my favorite stat on this slide is that the US middle market were its own country, it would be the 5th largest economy in the world, which also supports the reason behind the NCMM's work. The middle market indicator, which is we're going to focus on today, this is our longest continually running piece of research, and we also believe that it's the longest continually running study of the US middle market. Launched in April 2012, we survey 1,000 C-suite business leaders and financial decision makers at middle market companies all over the United States. We work with a market research firm called RTI Research to conduct this. And we have been measuring, largely the same things from survey to survey. KPIs in terms of their business performance, their growth, their confidence in the economy, where they're investing their capital, what are their key challenges. We also have custom questions within each of these waves, which I'm going to go through today. And it goes a little bit beyond the report that we publish on our site. But we'll talk about different things like talent, technology. As you might suspect, a big focus of this current wave and report is around uncertainty driven by trade policy, tariffs, interest rates, inflation, things in the macroeconomy. Again, these are all decision makers at companies between 10 million and $1 billion. The data gets weighted to the US business census so that it accurately reflects the middle market based on revenue size, industry, and geography. And this latest batch of information, we launched the survey due to some redesign that we did. It's actually pretty exciting. We put a lot of effort into updating and refreshing the MMI survey, mostly from an internal point of view to make it a little bit easier to manage and analyze, but also from the standpoint of just and then getting more relevant and explanatory information, I'll say, about how middle market companies are viewing some of these issues and also the tactics they're taking to address them. The survey was launched in roughly mid-June and went through early July, just actually right after the 4th of July holiday. So this information is relatively hot off the press and reflects your current thinking across these business leaders. Some of the themes that we'll see throughout this information, kind of summarized here on the right side of the slide. Noticeable slowdown in growth. So I will share this over the next couple of slides, but it stands out from the standpoint of what we've been seeing over the last 4 years, kind of post-pandemic. Now we are seeing a noticeable slowdown, both revenues and employment growth. From a workforce standpoint, while that hiring has slowed, we're not yet seeing middle market companies necessarily lay off or decrease their workforce. It's just they're hiring at a much slower pace. Subsequently, confidence is significantly lower than it was the last time we surveyed, which was back in December of 2024 for our year-end study. And again, a lot of that driven by uncertainty and all the changes that are happening from day to day. The challenges that exist, and we'll talk about these in more detail, inflation, uncertainty, the impact of trade policy, all of those are creating an environment where a lot of leaders are saying, I'm basically going to pause, or even worse, they're saying, I have to make several different plans and think about option A, B, or C, depending on the changes that are happening and announcements that are made. So again, it's causing a little bit of chaotic planning and execution, but as we've seen time and time again, middle market companies are well positioned with both the resilience and the flexibility to address this. So something that we'll continue to monitor. So let's take a look at the data, what's happening in the middle market today. This is a kind of a new question that we inserted. So typically we've started our survey with asking a relatively qualitative question about how has your business performed over the last 12 months. This doesn't necessarily replace that, but we did want to understand the most important strategic objectives within the middle market today. As you might suspect, not a lot of surprises on this list, with increasing revenue and sales ranked as the highest priority, followed closely by improving profitability and margins, so that balance between revenue and costs, reducing operational costs, expanding the customer base, and then, as we'll see later on in the presentation today, investing in technology. So all these important factors that play a role in really driving growth in the middle market, and we'll touch on some of these throughout the rest of the slides. So again, this is a bit different of a view than what I've shared previously, but this is more of a chart with some of the KPIs, and it's important to see here where we've trended, particularly over the last 2.5 years. So let's start at the revenue growth in the upper left. Again, we had seen pretty consistent around 12% or so growth rates. And this even goes back a little bit further to 2022. Now that has fallen off to 10.7% growth. Again, we're asking for the prior 12 months. So this is last half of 2024 into the first half of 2025. Similarly, hiring has slowed significantly. Average hiring rates around 10% or more growth in the overall number of people added on average across the middle market. That has now slowed down to about 7.5%. Future projection, we always comment that this number tends to be highly conservative, and actuals always outpace the projection, but For the next 12 months, revenue is projected at right around 8% growth. So not too much out of line with what we've seen in prior projections. And as I mentioned, they tend to be highly conservative. But on a relative note, confidence has also fallen across the board, particularly since the end of the year. So at the global level, confidence went from 75% down to 72. National is where we see the biggest impact. We were at 84% to end the year last year. It's now 73. And local, where middle market companies have always tended to have the most amount of confidence, just based on their standing in the community, their employers, suppliers, customers all tend to be local and regional. That is at 86%, which is also a bit of a dip from where we ended the year, which was at 90% confidence. So what does all this mean? Well, we'll get into some more of the details, but essentially the story is uncertainty driving slowdown. There's been a pullback, certainly in growth rates, in confidence, but also in activity. And we're going to take a look at that here in a moment. Another dashboard that we share regularly. So yeah, again, I think I always say this, but if I was limited to a one-slide webinar, I probably want to use this one because it encapsulates a lot of the activity that's happening. So again, left side revenue growth, 10.7. I think that should actually be 10.1. I might have a data issue there. Versus the S&P, which was 0.5%. So that has still outpacing large companies. That's the proxy that we use. And then, as I just said on the last slide, about 8% projected for the next 12 months. In employment growth, this is where we're seeing a definite slowdown, around 7.5% employment growth. We compare this to ADP's reporting. Again, it's a headcount-based report, but a fairly good proxy for us. Where in the small business side, headcount 0 to 49 employees. Basically flat, no growth in the small business segment. And then large segment, we look at 500 employees and higher, grew at 2.5%. So again, that is a good proxy that we can use to compare our MMI data versus both the small and large segment from an employment standpoint, and then projected at about 7.5% for the next 12 months. Capital investment is where we're also seeing a pullback. So, at the year end, it was about 2/3 of the company saying that they were going to invest in their company, now down to 56%. Not as low as we saw maybe pandemic or coming out of those time periods, but certainly a significant change from our last wave and even a year ago. And then I also just touched on those economy metrics. So we are seeing a slowdown. That is 100% true. And this is the trend. I think this gives a much better picture of kind of where we stand today. So again, lots of data here. We're going all the way back to the genesis of the MMI in 2012, a couple years out of the financial crisis, and we saw very, very consistent growth, but it accelerated in the post-pandemic recovery. We know in highly inflationary environments that certainly rates and prices had increased, which contributes to some of that. But we also saw a lot of expansion, entering new markets, developing new products, in some cases, exploring new lines of capital and credit and things that would help fuel growth were happening from 2021, late 2021, when the economy started to reopen, into really the early part of this year. So I've boxed, that growth rate. So you think about 13 plus years of doing this. This is our 43rd wave of the MMI. Average growth has been 7.5% revenue growth. Post-pandemic, it's been 12, and now we're looking at 10.7. So I've circled the latest wave here. It is a pretty drastic slowdown. Now, is it higher than what it was before 2020? Certainly, but we know that there are factors that have been driving this slowdown. So let's dig into this a little bit more. And again, this is now the trend, and I've limited it to the last 4 years, but versus the S&P revenue growth. So again, we're at 10.7%. The S&P 0.5% growth in the same time period. The historical average, again, going back over 43 waves of this, 7.5%. So this gives you a sense of where we've been for the last 4 years, the drop off that we're now seeing in the middle market as of the mid-year, and then the next 12 months projected out at around 8%. Still outpacing large business growth, but much slower. And then if we dig even deeper and peel the onion back a bit, we can also see that there's been a decline in the what we call growth leaders, growth champions, so to speak, those that have been growing their revenues 10% or more, has been hovering around 55 to almost 60% over the last 3 years, now at just around 50% of the companies. I'm also looking at those that are saying that their revenues haven't changed or even worse, declining. And fortunately, we're not seeing that necessarily. Not a lot of difference this wave, with 16% of the companies saying flat to decreasing revenues, versus say the last 2 years. It's in the same range. So that is something we'll continue to keep our eye on too. If these conditions continue on into the fall, we're definitely going to be interested to see what happens at our next survey, which will take place in December for the year end. But so far, we're not seeing a drop off, at least in that standpoint. We can also look at this by industry. So these are some of the main industries that we track. We can see that growth has been happening at higher levels, specifically as we look across business services. So these are professional services, B2B activities. I use examples like law firms, accounting firms, anything that's providing that service aspect. Financial services, again, more of a niche service line, but also strong growth there at 12.6, and then construction at 10.8. As we think about the projection in the next 12 months, we're actually seeing financial services with a strong projection, 10.8. We're also seeing retail at close to 9%, and then manufacturing at close to 10% in the projections. So a lot of this, the average is actually being dragged down if we look at all these by this other bucket. And those are all the smaller industry segments that don't fit into these broader categories, but still make up elements of the middle market. We just kind of lump those all together into this other category. And those are the niche industries and sub-industries that are actually kind of pulling down the average at this point. Expansionary activity dropped. So again, this is looking at prior 12 months, and we're looking at some key areas like new product service introduction, expanding into new domestic markets, adding facilities, whether that be office buildings, warehouses, other facilities, taking on new debt. So versus a year ago, still a little bit higher in terms of services and markets, a little bit lower in terms of plant and facility if we compare to the mid-year of 2024, but all of those metrics have declined a bit versus the end of the year 2024. So yeah, you can compare back going to the second quarter or the mid-year of 2021, and we're at a spot that's relatively consistent. But I would say, I'm paying attention to the drop off that we've seen, particularly in the last 6 months, and curious to see if this continues throughout the rest of the calendar year 2025. Employment, again, we can take kind of similar deep dives. So the boxed area represents this consistently strong employment growth. 5.1% is the total MMI average over 13 years. We've certainly been seeing higher than that, more around 10.5% growth. And then this drop off of like 3 full percentage points to 7.4 and projected at 7.6. The lines below, the green and blue lines, again, those represent those ADP comparisons. where regardless of the specific number, middle market continues to outpace employment growth in both the large and small business rates based on the ADP data. And that is certainly true for this latest round as well, where large business growth was at 2.5 and small at 0.4. And then if we look at it by kind of growth rates, again, I kind of focus on both ends of the spectrum. I look at the high growers, so employment, workforce growing 10% or more has been chugging along at mid 40% in terms of our sample, now down to 36%. And even if you look at the top, based on where we were at the end of 2024, where almost 2/3 of the middle market say that their workforce increased, now we're closer to half of the middle market, 54% of the companies. And then at the bottom end, 47% have experienced either no change, they've kept their staffing flat, or 8% have actually decreased their workforce. So not a huge rush to lay off people, shrink payrolls. None of that is happening yet. And again, we believe that's based on the profile that we've seen over the years of middle market companies taking a longer view of short-term challenges and issues. Because of the nature of their private, they don't have to necessarily be beholden to earnings calls, Wall Street expectations, those types of things. So I would not expect to see a big rush unless these conditions persist for an extended period. And then from an industry standpoint, I mean, no surprise that some of the fast growers are also the fast adders of talent to their payrolls. Financial services at 10.9%, manufacturing as well, almost 11%, and retail trade at 8.6%. And then projections for the coming 12 months, again, manufacturing, financial services, retail trade kind of leading the way. Construction also looking to add people. That other bucket, again, stands out as an outlier for being significantly lower as an aggregation. I believe in this round, it was maybe 20% of the sample, so close to 200 companies that fell into that. But again, all weighted to the census. So smaller in that area, which tends to drag the average down. Confidence, again, this gives you a bit of a trend. So, confidence kind of spikes up and down depending on current conditions. You think about particularly nationally and globally, tends to be influenced more by what's happening, things that are in the news, whether they be geopolitical events, wars. We still have, Eastern Europe, now Middle East. I mean, those things have been going on now for a couple of years. But closer to home, things that are happening that would directly impact more of a local economic view, particularly around the impact of trade policy and the fact that interest rates are still high, particularly relatively to related to pre-pandemic. The cost of borrowing, the cost of getting capital and credit remains a challenge, and so those are contributing to some of the numbers that we're seeing here, particularly as they've dropped since the end of last year. But local economy relatively on par with where we were a year ago, and even the last, say, 2 years. This is our investment chart. So again, as a reminder, in the survey, we asked this question: if you had an additional dollar of revenue, what would you do with that revenue? Would you save it as cash, save it for future financial investment, or would you invest it back? And then we have a list of options of where they could invest. So it's a kind of an interesting visual here. As you can see that, obviously the huge dip when we hit the pandemic, we saw a decline down to about, it was roughly 50-50, really in the first summer of COVID. when we surveyed right after everything shut down, it was almost 50-50. Despite all that strong performance that I showed previously, the investment sentiment has lagged a bit, but it started to tick up. The last two waves, we saw 63 and then 65% of companies telling us they're going to invest that dollar, but then it dropped back down to 56%. And again, driven by the uncertain conditions and that more defensive posture description that I mentioned earlier. Well, for the 56% that would invest, what are they doing with it? Well, the big standout here is it's all about AI. So technology specifically, but even more specifically, AI is the big target. 21% of the respondents said they're putting dollars into AI tools, an additional 20% saying different types of technology. And I'll get into this topic in a little bit more detail later as to why this is important, but those remain the main targets for capital investment, followed by plant and equipment, facilities, and then some of the people things around personnel training and development. We also have a new option here around mediating risk. So just under 10% of the companies said that they're investing into risk mediation and risk management. The savers, so the 44% that are going to save, more of them are holding as cash, which makes a lot of sense with uncertain conditions, having that cash is king mentality to be able to react when things might change or improve, or just having that reserve, so to speak, is also behavior that we've seen from middle market leaders in the past. So it doesn't surprise us that about 50% are holding cash. The other 50 are thinking about a future investment, whether it be an acquisition, a market expansion, could be some of the tools we see here in the other chart, but they're saving and holding on to that. And then this is a forward-looking view of expansion. So in the next 12 months, what we asked, like, what are your company thinking about doing in terms of driving growth? And again, it just continues. This is an interesting one because it's been a trend that we saw. We've actually about over 2 years, these activities, projected activities have continued to kind of slide, and we're not seeing anything different in this wave as well. The top line there, 55% would expect to introduce a new product or service. Half the companies expect to enter new domestic markets. And then at the bottom there, that clumping of all the rest, you're talking about things like equity investment, new lines of credit, plant and facility, expanding into new international markets, which could be particularly interesting given what's been going on. So all of those tend to aggregate much, much lower on the list, with product, service, and market expansion leading the way. So challenges, again, this is, we allow the respondents to enter in open-ended questions, and they're aggregated into bigger themes. We see economic and financial challenges facing the middle market, inflation, costs, uncertainty, tariffs and trade policies, competitive pressures are also in there as well. And we'll talk a little bit more about this. So let's get into some of the more core business issues that are happening. This is a new chart that we have for this wave, looking at some of the top challenges across the middle market. And I've circled some of the highlights here around inflation and costs. So whether it be materials, inputs, wages, economic uncertainty, 40% of the companies are citing that. 41% concerned about the impacts of trade and tariffs, and then 38% about attracting and hiring talent, which has remained an ongoing issue for at least the last 10 years. Talent has been in the top 3 challenges that middle market companies have cited. But you can see the list of other things on here as well, bucketed by economic, workforce, market, and operation and technology. So this allows the center to keep a pulse on all the things that companies are thinking about and some of the needs that they have in terms of addressing these challenges. Risks, so inflation, supply chain, cyber, digital, all of these things continue to be big issues. Supply chain risk, though, rising to the top, almost 20% ranked it as their top risk. 40% had it ranked in the top three. And that's all as a result of what could happen with global supply chains. As we know, a small percentage of middle market companies participate internationally, and very small percentage of their revenues come from international markets. Across the middle market as a whole, it's about 5-6%, but the supply chain is largely dependent on other countries. We have the data behind where sourcing occurs, as you would expect, a lot within North America, both Canada and Mexico, followed by Europe and other sources around the world. So it is a big factor in the supply chain, which is what makes the trade policy discussions so relevant to middle market companies. It's not so much where they're selling, but it's where they're sourcing and importing raw materials. So specifically, we did want to gather information about tariffs because we were fielding so many questions in the spring about the impact, what middle market companies were thinking, how they were responding, what they were doing. So certainly some of the either tactics or anticipated changes that companies would be doing as a result, of course, increasing customer prices. Companies pay the tariff, so they have the choice of either passing that along. They could eat the increased costs, which would, as you see on the list here, the second option, thereby reducing their margins. Increased material costs, disruptions in the supply chain, about a quarter of the companies citing that. Anticipation that they'll have difficulty competing on price because now they're forced to raise rates as a result. And then, even some of the other issues farther down the list, looking at alternative suppliers, right? Like whether they be domestic or international, but thinking about other sources, countries of sourcing. The administrative burden and complexity, I think this might be overlooked in a lot of cases, but seeing examples of leadership teams telling us and saying they're spending a lot of time coming up with plans and contingencies only to have to go back to the drawing board when conditions or terms or new announcements come out. So it's causing a little bit of chaos in the planning process. And then you can see that difficulty in their long-range planning. How concerned are these companies over the next 1 to 2 years? Well, 44% are saying they're extremely or very concerned. You add in somewhat, and it's 3/4 of the middle market have some degree of concern about what's going to happen. So will definitely be something that we keep our eye on. Current or anticipated impacts to the business. So the right-hand side, the red would be significant impacts. I'm going to focus on the bottom here where we see the very bottom of the list, costs of importing and bringing in, goods and materials. Going to be most prevalent in those capital and raw materials intensive industries. We think manufacturing, construction, retail. Clearly less of an issue in services, technology, healthcare. But some other challenges, right? Profitability, margins, supply chain stability, ability to plan and forecast, cost of goods sold. So what we're seeing in the broader news cycle and coverage across other business segments is also holding true within the middle market. They are not immune. They're not excluded from this impact. They're telling us these are going to be some of the big impacts of these policies. And then specifically as it relates around supply chain, levels of concern around how difficult it'll be with a lot of these supply chain activities. So forecasting demand, top of the list, right? 35% of the companies saying there could be volatility with that, dealing with the increases and changes in costs, supplier reliability and managing risk. And this would include things like some of the geopolitical risks. So when you have areas of the world that are experiencing wars, climate change, unrest, civil unrest. I mean, it could be anything that's happening that could cause potential risks and disruption to the supply chain. That becomes an issue. We know from previous work that a lot of middle market companies tend to develop deep singular relationships with suppliers. Now they're being forced to rethink whether they need to have more flexibility, have backups and multiple sources of supply, which again increases time, cost, coordination, all those things. And these companies often run lean, so that is a challenge. Logistics costs, transportation, a lot of issues that you see on this list, causing some degree of challenge. So as we shift to people, so another big issue that was raised in the list of challenges. I don't want to sound like all the news is bad, because one of the things we're seeing here is actually an improvement in the degree to which companies are being challenged around skills gaps. So again, historically, if you look at the very top line there, around 50% have been citing that they're extremely or very challenged. It's down to 32%, which tells us that over the course of time, there has been movement in terms of addressing training, development, upskilling, digital skill sets as more technology gets implemented. The fact that still 90% say they're to some degree challenged, but it's not as severe as it was, means that it is slowly being addressed by these companies. And I circled at the bottom there, a third are saying that there's really not any challenge at all around skills gap, which is much, much better than it has been, as you can see here, over the past few years. So with a lot of these kind of large, boulder type issues, it takes time for it to work through the middle market segment. But fortunately, we are seeing that from a skills point of view. And then another related topic is around business transition. We've been talking a lot recently about the potential in the next few years for business transition and turnover, particularly from the leadership and ownership point of view. What we're seeing here is there's been a bit of a pullback in that thinking. And again, as we saw during COVID, that is not at all surprising given the state of the market, uncertainty, maybe not being in the best position to, say, conduct an exit or a sale or a merger. So where this was extremely likely 6 months ago for about a quarter of the companies, we're now down to 17%. And 3/4 of the companies say that it's not very likely at all that they're going to experience this change in the next 24 months. So again, this tends to rise and fall with sentiment and kind of macro conditions, so we'll keep monitoring it, but I thought it was important to share the shift that we've seen recently. Digitization and AI, this will be kind of the last big theme that I cover, but this kind of shares some of the big goals and where companies are at with their digital strategy. There hasn't been a lot of movement here as it comes to having a digital plan, about thinking about tools like digital payments, about having a view of company financials and operations, and just the overall importance of using technology to manage both the customer facing as well as the back end operations. And we're just not seeing a big shift there. And similarly, with areas where companies are planning to invest technology in the future, as you saw in that capital investment slide, intelligence tools like AI leading the way, CRM software in terms of developing more marketing and customer engagement opportunities and tools, accounting software, expenses, things that are more back office focused will be the areas. Goals and benefits, no surprise. So cost savings, productivity, time, those are the big benefits that companies in the middle market are experiencing. Some of the barriers, and we've mentioned these before, cost, we still see some challenges around a lot of really great tools out there that just aren't scaled appropriately and are outside of the budget of a lot of these firms, particularly as we look at the lower or emerging middle market, as we call it, 10 million to 50 million in revenues, limited CapEx, have a need because they're growing fast and want to use these tools, but may not have the right capital or the right levels of dollars that they need to buy and implement. Time, mentioned this as it relates to having relatively lean teams, knowledge, resources, so on and so forth are some of the barriers that we're seeing. AI, so how companies are using AI, we know that it's becoming more popular, but where are they using it? It's around data analytics, automating routine tasks at 36%, machine learning, conversations, chat, things like that. Combination of all these things. About a quarter of the companies are citing as well. What I thought was really interesting was on the right-hand side. So while a very small minority are developing AI capabilities in-house, almost 60% are training their workforce actively on the use of AI. So this is a big shift from where we've seen the past couple of years, where overall adoption has been somewhat slow. We're seeing that accelerate in a big way with more and more middle market companies recognizing that they first have to identify the right AI tools for their business. Second, figuring out how it will be applied in their business. And then third, making sure that their teams are trained appropriately to manage AI. And we're seeing that happen right now. So this is a big shift that's occurring in the workplace. And then benefits, again, these are addressing a lot of the challenges that we have cited. Operational efficiency, operational costs. So if you're seeing an impact due to rising costs of goods, AI can help eat into that by reducing costs, improving the customer experience, driving revenue growth. The concerns remain around security, privacy. Again, these large language models, unless you have the right protection in place, they're going out and scouring the broader internet for information. Speaking from experience here at the university, we use Microsoft Copilot. We are protected by the university's data policy, so it makes it a little bit easier for us to use a tool like Copilot. But that is what middle market companies are citing. Implementation costs, the accuracy and reliability is a very valid concern. You can't just take what AI outputs are, even though it improves every single day. What's the saying is the AI that you use today will be the worst form because it every day gets better, but it does have to be validated. And then almost a quarter of the companies saying that they lack the skills, but as we just saw, most of them are working on developing those skills, which is great news. So to kind of end and summarize here, the middle market has experienced a slowdown. Clearly, we see in the data, and particularly versus the last 4 years of post-pandemic boom and recovery, things have fallen. Now, it's not, I don't want to overstate that it's fallen off a cliff but it is slowed down because of uncertainty, lower revenues, decreased hiring, lower confidence, lower expansion planning. The biggest challenges, again, inflation, this total degree of uncertainty, and then how trade and tariff policy is going to be managed. But on the bright side, AI is becoming much more of a prevalent tool for these businesses. It's becoming accessible, it's becoming necessary, and it's being used in many different ways, depending on industry and specific business need to address some of these talent shortages. Just a couple of previews of what we have coming up at the center. So for the first time, last year we collected Canadian middle market data. We used the exact same MMI survey, did a study of Canada. We did that again. We also added in Mexico. So for the first time in our history, we're going to have a holistic view of North America, certainly US, Canadian, Mexican samples, but also a view. And that's important because as it relates to trade, Canada and Mexico being the biggest trading partners for middle market companies, we want to explore those tariff challenges a bit from both sides of view. We have a project underway now looking at private debt and private equity in the middle market. That's with Future Standard, formerly FS Investments. And then we just kickstarted a project looking at veteran-owned middle market companies and some of the unique challenges and opportunities that they have, looking at most likely early 2026 for that project. So just a sneak peek for what we have in our pipeline. Again, I would invite you to visit our website for more details. We have the MMI report. We have data that we publish. We have industry infographics. So it's a great hub and resource. You can also subscribe if you're not already a subscriber to our biweekly newsletter. And finally, I would say if we weren't able to get to your questions, you can send us an email at middlemarketcenter@osu.edu, I believe is our generic email. You can also find it on the website. But feel free at any time to shoot us questions if you need clarification or more information about any of these topics. Our next MMI will be the year-end report, which will publish in January 2026. Again, that data will be collected in December, so always interesting to see how conditions change over the coming 6 months. But as we can see, there are a lot of issues that have bubbled up this year that were not around previously that we're going to keep our eye on, and again, work across our partners and other groups in our middle market ecosystem to help address. So with that, thank you for your time. Hope you took away some great information from this, and we look forward to seeing you all soon. Thanks.